Stop everything you're doing right now because what I'm about to share with you is so monumentally important that it could be the difference between preserving generational wealth and watching your life savings evaporate. Today is Saturday, January 25th, 2026, and we are standing at the threshold of the greatest wealth transfer in modern financial history. And I'm not being hyperbolic. I'm not exaggerating for effect. What I have in my hands right now are documents from Bank of America, one of the largest financial institutions on planet Earth. And what they're forecasting for gold and silver prices over the next few months is so shocking that when I first read it, I had to go back and verify the numbers 3 times because I couldn't believe a major bank was actually putting this in writing. Let me start with the headline that should be on the front page of every financial newspaper in the world, but isn't because the mainstream media doesn't want you to know this information. Bank of America is now officially forecasting gold to hit $6,000 per ounce by spring of 2026. That's right. We're talking about spring, which is literally 8 to 12 weeks away. Not 5 years from now, not a decade from now, spring of this year. And they're not stopping there. Their analysis suggests that if investment demand increases by just 55%, which is entirely realistic given current market conditions, gold could reach $8,000 per ounce. Let that sink in for a moment. The most conservative major bank in America just told their institutional clients that gold is going to $8,000. But here's where it gets even more interesting for those of us who understand the silver market. In that same research report, Bank of America's commodity strategist specifically addressed silver, and the numbers they're throwing around are staggering. They cited the historical gold to silver ratio, and here's what that means for silver prices. In 1980, the gold to silver ratio hit a low of 14 to 1. If we apply that same ratio to today's gold price, which is currently hovering around $4,180 per ounce, that would put silver at $355 per ounce. Let me repeat that because I want to make absolutely certain you understand what a major financial institution just implied. $355 per ounce of silver based on historical precedent and current gold prices. Now, Bank of America didn't come right out and say silver is going to $355 because that would cause absolute panic in the markets. Instead, they used more conservative language. They mentioned that based on the 2011 gold to silver ratio low of 32 to 1, silver could reach $135 per ounce. And even using the most conservative estimate, applying the current ratio, they're looking at silver north of $90 per ounce as a baseline. But here's what you need to understand about how these banks operate. When they publish price targets, they're giving you the absolute floor, the most conservative estimate they can justify to their legal department. The real numbers, the numbers they're telling their private wealth management clients behind closed doors, are significantly higher. And I can prove this to you with data that's coming directly from the physical markets right now. As I'm recording this on January 25th, silver is trading at approximately $100 per ounce on the COMEX paper exchange. But if you actually try to buy physical silver in the real world, you're going to pay between $117 and $130 depending on the product and the dealer. I pulled up JM Bullion's website last night, and a 2026 American Silver Eagle is listed at $117 per ounce if you buy in quantity. That's a 17% premium over the paper price. But it gets even more interesting when you look at what's happening in Asia. Eric Yang, who has direct connections to the Chinese precious metals markets, reported yesterday that recyclers in China are currently offering to buy silver from the public at $112 per ounce, VAT exempt. That means ordinary Chinese citizens can walk into a recycling center and sell their silver for $112 cash, which is $12 above the COMEX spot price. And in the Shenzhen Shuibei gold market, which is one of the largest physical precious metals markets in the world, silver was trading at the equivalent of $128 per ounce when you account for the VAT tax that's built into their pricing structure. Do you understand what this means? It means the paper price on the COMEX is completely divorced from the physical reality. There are now 2 separate silver markets operating simultaneously. There's the fictional paper market in New York where banks trade contracts that reference silver that doesn't exist and will never be delivered. And then there's the real physical market in Asia where actual metal changes hands and the price is determined by genuine supply and demand. And the spread between these 2 markets is widening by the day. This is the arbitrage opportunity of a lifetime, and it's being exploited on a massive scale right now. Here's how it works. Large institutional buyers are purchasing silver contracts on the COMEX at $100 per ounce, taking physical delivery, and immediately shipping that metal to Shanghai or Mumbai, where they can sell it for $128. That's a $28 profit per ounce with virtually zero risk. And this arbitrage is creating what I call the Great Silver Drain, a one-way flow of physical metal from west to east that is irreversible and accelerating. John Rich, who has 1.4 million followers on Twitter, posted about this exact phenomenon 2 days ago. He said, That suction sound you hear is China draining the American stockpiles of silver through arbitrage. And he's absolutely correct. China and India are vacuuming up every available ounce of physical silver in the Western world. They're not buying it for speculation. They're not buying it to flip it for a quick profit. They're accumulating it as a strategic monetary asset because they understand something that most Americans don't. The US dollar is dying, and when the dollar loses its reserve currency status, the countries that hold the most gold and silver will write the rules for the new global monetary system. Let me share some data with you that's not widely known. Keith Neumeyer, the CEO of First Majestic Silver, one of the largest primary silver mining companies in the world, went on the Arcadia Economics podcast recently and revealed something shocking. He said that for the first time in his 23-year career running silver mines, he has received direct calls from buyers in Asia asking to purchase silver straight from the mine, bypassing all traditional distribution channels. Think about what that means. These buyers don't want to go through the COMEX. They don't want to deal with the LBMA in London. They don't trust the Western paper markets. They want to buy physical metal directly from the source and have it shipped immediately to vaults in Shanghai or Singapore. This is not a retail-driven rally. I want to be very clear about this because I see a lot of confusion in the precious metals community. People are looking at their local coin shops and saying, well, my dealer still has some silver available, so there must not be a real shortage. That's missing the entire point. The retail market is a tiny fraction of overall silver demand. We're talking about maybe 5 to 10% of total annual consumption. The real action is happening at the institutional and sovereign level, and that's where the shortage is most acute. The industrial users of silver, companies like Samsung, Tesla, solar panel manufacturers, are in full panic mode right now. Silver is an irreplaceable component in their products. There is no substitute that works as well. And when the price went from $25 to $100 in less than a year, it completely destroyed their procurement budgets. But they can't stop buying. If Samsung stops buying silver, they stop making phones and televisions. If Tesla stops buying silver, they stop making electric vehicles. So these companies are now competing directly with sovereign nations and billionaire investors for the same finite supply of metal. And that competition is pushing prices into the stratosphere. Now let me address the elephant in the room. A lot of people are asking, if silver is really in such high demand, why can I still buy it from dealers? Why hasn't everything sold out completely? The answer is that there's a massive liquidation happening right now in the United States. Ordinary Americans who bought silver at $20 or $30 per ounce are selling into this rally. They're taking profits, and I don't blame them. If you bought silver at $25 and you can sell it for $100, that's a 400% return. That's life-changing money for a lot of people. So that metal is coming back into the market temporarily. But here's the critical point. That silver is not staying in the United States. It's being immediately shipped to Asia. American citizens are selling their silver to local coin shops. The coin shops are selling to wholesalers. And the wholesalers are selling to Chinese and Indian buyers who are paying premiums to get the metal out of the country as fast as possible. This is a one-way transfer of wealth from the west to the east, and it's happening at a scale that's difficult to comprehend. One of my local coin shops, a large operation that's been in business for over 30 years, is currently not buying silver. Not because they don't want it, but because the refineries are so backed up that they can't process the metal fast enough. And why are the refineries backed up? Because they're working around the clock melting down American silver coins and bars and turning them into 1,000-ounce good delivery bars that meet the specifications required by the Shanghai Gold Exchange. The metal is literally being melted down and shipped overseas within days of being purchased from American sellers. This brings me to the supply side of the equation, and this is where Bank of America's research gets truly alarming. In their report, they revealed something that I had not seen reported anywhere else. The 13 largest North American gold mining companies are projected to produce 19.2 million ounces of gold in 2026. That represents a 2% decline from 2025 production levels. Stop and think about that for a moment. We are in the greatest gold bull market in history. The price has gone from $100 to $800 to nearly $5,000 in less than 2 years. The mining companies are making record profits. They have every financial incentive to maximize production, and yet production is declining. Why? Because the easy gold has already been mined. The high-grade deposits that could be extracted cheaply are depleted. The remaining gold is in lower-grade ores that require more energy, more labor, and more capital to process. And even with gold at $5,000 per ounce, it's becoming harder and harder to maintain current production levels, let alone increase them. Bank of America's analysts specifically noted that most other market forecasts are too optimistic about future gold production, meaning the supply situation is actually worse than the consensus believes. And if that's true for gold, it's 10 times more true for silver. Silver is primarily a byproduct of base metal mining. About 70% of all silver production comes from mines that are digging for copper, lead, zinc, or gold, and silver just happens to come along with it. This means that silver production is not really responsive to silver prices. If the price of silver goes to $200, copper mines don't suddenly start producing more copper to get the silver. They mine copper based on copper demand, and whatever silver comes out is secondary. The annual mine supply of silver is approximately 800 million ounces. Total demand, including industrial use, investment demand, and jewelry, is now running at about 1.2 billion ounces per year. That's a structural deficit of 400 million ounces that has to come from somewhere. For years, that deficit was filled by above-ground stockpiles, by central bank sales, by recycling of old electronics and silverware, but those stockpiles are now largely depleted. The silver that's being recycled is immediately consumed by industrial users. There is no longer a buffer inventory sitting in warehouses waiting to be sold into rallies. This is why the price trajectory is so explosive. When you have demand exceeding supply by 33%, and that deficit cannot be filled from existing inventories, the only mechanism that can bring the market back into balance is price. Price has to rise to a level that either destroys demand or incentivizes new supply. At $100 per ounce, we are nowhere near demand destruction. Industrial users are still buying every ounce they can get their hands on. Investors are accumulating more aggressively than ever, and sovereign nations are treating silver as a strategic asset that must be acquired regardless of price. So what price would be required to incentivize new supply? According to industry analysts, the all-in sustaining cost for primary silver mines, the ones that are specifically digging for silver rather than getting it as a byproduct, is now between $18 and $25 per ounce, depending on the jurisdiction. But that's just the operating cost. If you want to bring a brand new silver mine online, you need to factor in exploration costs, permitting, environmental studies, construction of the mine and processing facilities, and all the other capital expenses. When you account for all of that, the incentive price, the price at which mining companies will commit capital to develop new silver projects, is estimated to be somewhere between $150 and $200 per ounce. But even if silver hits $200 tomorrow and companies immediately greenlight new mining projects, it takes 5 to 7 years minimum to bring a new mine from discovery to production. So even in the best case scenario, new supply won't hit the market until 2031 or later. And that assumes that permitting goes smoothly, that there are no environmental challenges, that labor and equipment are available, and that the company can secure financing. In reality, the timeline is probably closer to a decade for most projects. This is the supply cliff that everyone in the industry is quietly talking about, but the mainstream media refuses to acknowledge. We are running out of silver at a time when demand is exploding, and there is no quick fix. The market is going to have to ration available supply by allowing price to rise to whatever level is necessary to balance supply and demand. And based on the fundamentals, that equilibrium price is far, far higher than where we are today. Now let me talk about the technical picture, because there's a lot of confusion about whether silver is overbought and due for a correction. The traditional technical indicators, things like the relative strength index and moving average convergence divergence, are all showing extreme overbought conditions. Every technical analyst who uses these traditional tools is calling for a pullback. And you know what? They might be right. Silver could absolutely drop 10 or 20% in a sharp correction. We could see $90 or even $80 silver again in the near term. But here's what the traditional technical analysts are missing. Overbought does not mean overvalued. These are two completely different concepts. Overbought means that the price has risen very quickly and is trading above its recent historical range. Overvalued means that the price is higher than the fundamental value of the asset justifies. And according to Bank of America's research, precious metals are not overvalued. In fact, they're still dramatically underinvested. Here's the data that should blow your mind. Gold currently represents about 4% of total global financial assets. That sounds like a lot until you dig deeper. Among high net worth individuals, the people with investable assets over $1 million, gold represents only 0.5% of their portfolios. Half of 1%. Think about what happens if those high net worth investors decide they should increase their gold allocation from 0.5% to just 3%. That would require them to increase their gold holdings by 6 times. Where is all that gold going to come from? The annual mine supply is completely spoken for. The only way the market can accommodate that demand is through massive price appreciation that convinces current holders to sell. And Bank of America's modeling goes even further. They state explicitly that when you run the analysis on optimal portfolio construction, retail investors should have a gold allocation well above 20%. Some of their models justify allocations as high as 30%. Now apply that to silver. If the recommendation for gold is 20 to 30% and silver has more upside potential due to the lower market cap and the supply deficit, what should the recommended allocation be for silver? 10%? 15%? Let's do some simple math. There are approximately 56 million millionaires in the world. If each of them decided to allocate just 10% of their wealth to silver, and the average millionaire has, let's say, $2.5 million in investable assets, that's $250,000 per person going into silver. Multiply that by 56 million millionaires and you get $14 trillion of demand. The entire above-ground investment-grade silver supply is worth maybe $200 billion at current prices. Do you see the problem? There is not enough silver on planet Earth to satisfy even a modest allocation by high net worth investors. The only way the market can clear is if prices rise to levels that seem absolutely absurd by today's standards. And this is before we even talk about central banks. Bank of America's report revealed that central banks now hold more gold than US Treasury bonds in their reserve portfolios. Gold represents an average of about 15% of total central bank reserves globally. But their modeling indicates that reserves would be fully optimized with a gold allocation around 30%. If central banks globally decide to double their gold holdings from 15% to 30%, we're talking about demand for tens of thousands of tons of gold that simply doesn't exist in available inventory. And while central banks have historically ignored silver, that's starting to change. We're seeing reports of sovereign wealth funds and government-affiliated entities quietly accumulating silver in large quantities. Why? Because silver is massively undervalued relative to gold. The current gold to silver ratio is approximately 50 to 1. Historically, that ratio has averaged between 15 to 1 and 30 to 1 over long time periods. If the ratio reverts to the historical mean while gold is at $5,000, silver would be worth between $166 and $333 per ounce, depending on which historical average you use. Let me bring in some additional analysis from one of the most respected technical analysts in the precious metal space. Michael Oliver, who is known for being bearish more often than bullish, recently went on record saying that he expects silver to reach between $200 and $500 per ounce by the second quarter of 2026. That's April, May, June of this year. When I first heard him say this, I thought maybe he misspoke or the interviewer misunderstood him. But no, he was very clear. He said the verticality in silver has only just begun, and he's comparing the current setup in silver to what happened in copper and other industrial metals during previous bull markets. When those metals went parabolic, they didn't stop at double or triple their previous highs. They went 5, 10, sometimes 15 times higher before the move exhausted itself. And Michael Oliver's track record gives his predictions significant credibility. This is not some permabull who's always calling for the moon. This is someone who has correctly called major turning points in precious metals for decades. When he says we could see $500 silver in the next few months, I pay attention. Now, do I think $500 is guaranteed? No. Markets are unpredictable, and all kinds of things could happen. But do I think it's possible? Absolutely, and I'll tell you why. We are living through a period of geopolitical chaos that has no modern parallel. The relationship between the United States and China is at its lowest point since the 1970s. Russia has been completely cut off from the Western financial system. The Middle East is a powder keg. The European Union is fracturing. And most importantly, trust in the US dollar as the global reserve currency is evaporating. When Russia's foreign exchange reserves were frozen and seized in 2022, every country in the world took notice. The message was clear. If you hold your reserves in dollars and you cross the United States, your wealth can be confiscated at the push of a button. This is why we're seeing a massive global shift toward hard assets. Countries that don't trust each other and don't trust the dollar are accumulating gold and silver because those assets cannot be frozen, cannot be seized remotely, and cannot be devalued by a central bank printing press. The world is preparing for a post-dollar monetary system, and the foundation of that system will be commodity backing, specifically gold and silver. The BRICS nations, Brazil, Russia, India, China, and South Africa, plus the more than 40 countries that have applied to join, are in advanced stages of creating a new trade settlement system that bypasses the dollar entirely. And at the heart of this system is a basket of commodities including gold, silver, oil, and other strategic resources. When this system goes live, which could happen within the next 12 months, the demand for physical precious metals is going to explode because every country that wants to participate in BRICS trade will need to hold significant quantities of gold and silver to settle transactions. This is the geopolitical backdrop that makes Bank of America's price targets not only plausible, but potentially conservative. We are not in a normal market environment. We are in the early stages of a complete restructuring of the global monetary system, and the countries and individuals who position themselves correctly right now will emerge from this transition with generational wealth intact. Those who don't will see their dollar-denominated assets lose 70 to 90% of their purchasing power. Now let me address what I think is going to happen in the very near term, because I know that's what everyone wants to know. What's going to happen Monday morning when the markets open? What's going to happen next week? Here's my honest assessment. I think we are going to see extreme volatility. By that, I mean, I would not be surprised to see silver move $10 or more in a single day, either direction. I have about a 58% confidence level that the move will be to the upside, meaning we could see $110 or $115 on silver early next week. But there's also about a 42% chance that we get a sharp correction down to $90 or even $85. And here's the thing. It doesn't matter. If you're a long-term holder of physical silver, these short-term price swings are irrelevant noise. What matters is the 5-year trajectory, the 10-year trajectory. And that trajectory is pointing to prices that most people today would consider absolutely insane. We are going to see $200 silver. I have no doubt about that. The only question is whether it happens in 6 months or 2 years. And I personally think it's going to be sooner rather than later, because the fundamentals have never been this bullish and the geopolitical situation has never been this precarious. And let me share some additional data that supports the case for much higher prices. There's a technical analyst named Rashad who has been remarkably accurate in his silver predictions over the last year. He recently posted his updated forecast, and here's what he's expecting. He thinks silver will initially spike to between $125 and $130 in the very near term. Then we'll get a sharp 15% correction, which would take us back to around $110. And after that shakeout of weak hands, he's calling for the mother of all rallies to $250 to $300 in a short period of time, possibly just a few weeks. Is he right? I don't know, but his track record suggests we should take his analysis seriously. And his forecast aligns with what we're hearing from other credible analysts. The consensus among people who really understand these markets is that we're in the early stages of a blow-off top that could take silver to levels that seem impossible right now. There's also interesting momentum analysis that suggests acceleration. One analyst pointed out that silver's price moves are happening faster and faster. The first $20 move took 5 years. The next $20 move took 99 days. The next $20 move took just 28 days. And the most recent $20 move took only 17 days. This is classic parabolic behavior. Each leg up happens faster than the previous one. And if that pattern continues, the next $20 move could happen in less than a week. Now, I want to talk about what you should be doing right now if you don't already own physical silver. The answer is complicated, because the market dynamics have changed so dramatically. 6 months ago, I would have said, just go to any major online dealer, place an order, and you'll have your silver in a few days. Today, that's not the reality. Most major dealers are showing sold out across their entire product lines. The dealers that do have inventory are charging massive premiums. A silver eagle that used to sell for $3 over spot is now selling for $15 to $20 over spot. So what do? You have several options. Option 1, you wait for a correction and hope that premiums come down and inventory becomes more available. The risk with this strategy is that the correction might not happen, or it might be very brief, or inventory might not materialize even during a correction. Option 2, you pay the current premiums and acquire whatever physical metal you can get your hands on right now. This is expensive, but it guarantees you have the metal before things get even crazier. Option 3, you go peer-to-peer. You find private sellers in your local area through precious metals clubs, online forums, or personal networks. The advantage of peer-to-peer transactions is that you can often negotiate better prices than what dealers are charging, plus you get the metal immediately with no shipping delays. The disadvantage is that you need to be very careful about authenticity, and you need to handle your own security when transacting in cash for large amounts of silver. My personal recommendation, and this is not financial advice, just my opinion, is a combination approach. If you have zero physical silver right now, I would acquire at least some immediately, even if you have to pay elevated premiums, just to have a position in case things go completely crazy. Then I would dollar cost average into larger positions over the next few months, buying on dips when they occur. And I would build relationships with private sellers so you have peer-to-peer options available when retail channels are frozen. I also want to address storage and security because this is becoming increasingly important. If you're going to own significant amounts of precious metals, you need a real security plan. Do not store everything in one location. Diversify your storage across multiple secure sites, some at home in a well-hidden safe, some in private vault facilities that are not affiliated with banks, and if possible, some in jurisdictions outside your home country. And whatever you do not advertise the fact that you own precious metals. Don't post about it on social media. Don't brag to friends and neighbors. Don't wear silver jewelry that screams, "I'm a precious metals investor." The fewer people who know about your holdings, the safer you are. We have historical precedent for government confiscation of precious metals. In 1933, Franklin Roosevelt signed an executive order making it illegal for Americans to own gold. The government forced everyone to turn in their gold at 20.67 per ounce, then immediately revalued it to $35, confiscating 40% of the wealth of every gold holder. Could this happen again? I think it's possible once we get deep enough into the crisis that governments become desperate. This is why international diversification of your storage is so important. If your metal is in a jurisdiction that your home government cannot easily access, you have protection against confiscation. I'm not a lawyer, I'm not giving legal advice, but this is a risk that every precious metals investor needs to consider and plan for. Let me wrap this up by giving you the big picture of what I think is going to happen over the next 12 to 18 months. We are currently in phase 1 of a 4-phase transition. Phase 1 is the physical shortage and the breakdown of traditional distribution channels. This is where we are today. Premiums are exploding, delivery times are extending, and the spread between paper and physical prices is widening. This phase continues until the paper markets break completely. Phase 2 will be the COMEX default. At some point, probably within the next 3 to 6 months, a large institutional buyer is going to stand for physical delivery on a futures contract, and the exchange will fail to deliver the metal. This has never happened in the 50-year history of the COMEX, but given current supply constraints, it's inevitable. When this happens, confidence in the paper markets will collapse completely. The paper price and the physical price will diverge permanently. Paper contracts will trade at massive discounts to physical metal. Phase 3 is what I call the sovereign scramble. Once the COMEX defaults and everyone realizes the paper markets are fraudulent, central banks and sovereign wealth funds will panic. They will attempt to acquire physical gold and silver at any price to shore up their reserves before their currencies lose all credibility. This is when we see $300, $400, $500 silver. This is when shortages become absolute. Retail investors will not be able to buy metal at any price because governments will nationalize mines, implement export bans, and potentially confiscate private holdings. Phase 4 is the reset. The IMF, the Bank for International Settlements, and the major central banks will announce a new global monetary framework. It will involve some form of commodity backing, probably a basket of gold, silver, oil, and other resources. The dollar will be officially devalued by 60 to 80% against this basket. Anyone holding dollar-denominated assets will see their wealth evaporate. But anyone holding physical gold and silver will see their wealth multiply several times over. This is the roadmap. This is what's coming. And we're standing at the threshold right now on January 25th, 2026, at the doorway to the greatest opportunity and the greatest crisis of our lifetimes. The question is, are you positioned correctly? Do you own enough physical metal? Is it stored securely? Do you have a plan for what you'll do when your neighbors come knocking, asking how they can get silver? The time to act is now. While physical metal is still available at any price, the window is closing. Bank of America just told you gold is going to $6,000 and potentially $8,000. They told you silver could hit $135 based on conservative ratios. But the real number, the number that the fundamentals support, is $253 at minimum, with potential for much, much higher. Don't say you weren't warned. Don't say nobody told you. The information is right here. The data is clear. The only question is whether you'll have the courage to act on it. The greatest wealth transfer in history is happening right now. Make sure you're on the right side of it.